Thank you. Good evening and a warm welcome to our second quarter fiscal 19 earnings call. I'm Nimish from the Sun Pharma Investor Relations team. We hope you've received the Q2 financials and the press release that was sent out earlier in the day. These are also available on our website. We have with us Mr. Dilip Sanghavi, Managing Director, Mr. Sudhir Walia, Whole-Time Director, Mr. Kal Sundaram, Whole-Time Director and CEO of India Emerging Markets and Consumer Healthcare Business, and Mr. Abhay Gandhi, CEO of North America. Today the team will discuss performance highlights, update on strategies and respond to any questions that you may have. As is usual, for the ease of discussion, we'll look at consolidated financials. Just as a reminder, this call is being recorded and a replay will be available for the next few days. The call transcript will also be put up on our website shortly. The discussion today might include certain forward-looking statements, and this must be viewed in conjunction with the risks that our business faces. You are requested to ask 2 questions in the initial round. If you have more questions, you are requested to rejoin the queue. I also request all of you to kindly send in your questions that may remain unanswered today. I will now hand over the call to Mr. Sanghavi.
Welcome and thank you for joining us for this earnings call after the announcement of financial results for the second quarter of FY19. Let me discuss some of the key highlights. Our overall sales for the quarter were at 6,846 crores, a growth of 4% over the same quarter last year. Our soft Q2 performance does not reflect the actual health of the underlying business. We continue to focus on strengthening our core operations and enhancing our overall efficiencies, and we are fairly positive on our performance for the rest of the year. We continue to progress further in our specialty initiatives. Abhay will discuss more details on our specialty initiatives later. We also continue with our efforts to control costs and improving efficiencies. These steps are necessary to ensure that we continue to earn reasonable returns in the current competitive state of the U.S. generic market. Post the clearance of Halol facility by the FDA in June, we've started receiving approvals from Halol for the U.S. As indicated earlier, we expect a gradual increase in new approvals from Halol for the U.S. I will now hand over the call to Mr. Walia for discussion of the Q2 performance.
Thank you, Mr. Sanghavi. Good evening, everyone, and welcome to all of you. Our Q2 financials are already with you. As usual, we will look at the key consolidated financials. Overall Q2 sales are at rupees 6,846 crore, up by 4% over Q2 last year. Material cost as a percentage of the sales was 25.7%, lower than Q2 last year. Staff cost was at 21.5% of the sales, higher than Q2 last year. The increase in partly due to the expenses of a specialty team in the U.S. The other expenditure was at 31.8% of the sales, same as Q2 last year. As a result of the above, the EBITDA for Q2 was at rupees 1,440 crores with EBITDA margin at 21%. Adjusted net profit for Q2 for the 2019 was at rupees 996 crore with resulting adjusted net profit margin of 14.5%. After accounting for a provision of 1,214 crore for the estimated settlement amount payable to all remaining plaintiffs related to the modafinil antitrust litigation in the U.S., the net loss for the quarter was at 2,019 crore. Adjusted EPS for the quarter is ₹4.10. Let me now discuss the quarter-on-quarter movement. Material cost at 25.7% of sales was lower than June quarter, mainly due to the lower cost of goods for Taro and write back of certain provisions made in the past. Other expenses were higher than June quarter, mainly due to the build-out of the specialty business in the U.S. Now, we will discuss the half-year performance for first half. The net sales were at 13,985 crore, a growth of 10% over first half last year. Material cost as a percentage of the net sales was 27.6%, which is slightly lower than H1 last year. The staff cost for the first half was 20.8%, same as H1 last year, while other expenses were 30.4% lower than H1 last year. As a result of the above, the EBITDA for the first half was at 2,961 crore, a growth of 25% over first half last year. The resulting EBITDA margin is at 21.2%. The adjusted net profit H1 2019 was at 1,978 crore, up by 38% over H1 last year, with the resulting in adjusted net profit margin of 14%. The reported net profit for H1 at rupees 764 crore was after providing an amount of 1,214 crore for estimated settlement amount payable to all at the remaining plaintiff related to the Modafinil antitrust litigations in the U.S. Let me now briefly discuss Taro's performance. Taro posted for Q2 19 sales of 159 million, down 6% over Q2 last year. For the first half, the sales were 314 million, down 5% first half last year. The Taro net profit at Q2 was 63 million, up by 19% over Q2 last year. Net profit for first half 19 was 130 million, up by 21% over last half last year. I now hand over to Kal Sundaram, who will share the performance of our India and emerging market business.
Thank you, Mr. Walia. First, let me take you to the performance of our India business. For quarter 2, sales of branded formulation in India were 1,860 crores, a degrowth of 16% over Q2 last year, and accounting for approximately 27% of our total sales. The decline was mainly on account of a planned inventory reduction in supply chain, coupled with higher base of Q2 last year, which had witnessed post-GST restocking. Year to date, the secondary sales to stockists is tracking to plan and is growing at low teens year on year. Sun Pharma is the largest pharmaceutical company in India and holds approximately 8.3% market share in over 126,000 crore pharmaceutical market as per September 2018 AOICD AVAX report. As per latest SMSRC report, Sun Pharma is ranked number 1 based on share of prescriptions with 12 classes of doctors. For Q2, 13 new products were launched in the Indian market. Let me now discuss our performance in emerging markets. Our sales in emerging markets were $195 million for Q2 and accounting for 20% of total sales. While we continue to grow the business in local currency terms, many emerging market currencies have depreciated, thus impacting our reported growth for emerging markets. Key markets which contributed to the growth were Romania, Eastern Europe, Brazil, and Mexico and Latin markets. Now I'll hand over the call to Abhay. Abhay?
Thank you, Mr. Kal. I will briefly discuss the performance highlights of our U.S. businesses. For quarter 2, our overall sales in the U.S. were up by 11% at $342 million, accounting for approximately 35% of overall sales. Let me update you on the developments in our specialty business. We have recently commercialized Ilumya in U.S. and we are excited with the initial response to the launch. With this launch, we have already commercialized 2 specialty products in the U.S. in the first half. We have also received U.S. FDA approval for Cequa, and plan to launch it in the US during the course of this year. Although we have built the front-end infrastructure for the specialty business in the US, there would be specific marketing and other costs at the time of launch of these products. They will entail high upfront investments. I will now hand over the call to Mr. Shanghvi.
Thank you, Abhay. I will briefly discuss the performance highlights of our other business as well as give you an update on our R&D initiatives. Formulation sales in the rest of the world market, excluding US and emerging markets, were $108 million in Q2, a degrowth of 2% over last year. Rest of the markets accounted for approximately 11% of Q1 revenue. We continue to focus on developing and utilizing APIs for our captive consumption for benefits of vertical integration. For Q2, our external sales for our API business was rupees 426, up by 10% over Q2 last year. We continue to invest in R&D for enhancing our pipeline. Consolidated R&D investment for Q2 was rupees 452 crores, accounting for 6.6% of sales. Our current generic pipeline for the U.S. market includes 134 ANDAs and 6 NDAs awaiting approval for from the U.S. FDA. We expect higher R&D spending in the coming quarters for the specialty business. This R&D spending enables development of future product pipeline, including specialty and differentiated products. We also continue to critically evaluate generic R&D spend given the competitive nature of the U.S. generics market. With this, I would like to leave the floor open for questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Qtr2 from HDFC Asset Management. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, can you indicate the magnitude of increase in the specialty operating expenditure that we've seen in the first half of FY19? A ballpark should help, sir.
Abhay?
I think the most significant expense that we have incurred in the quarter is on the expansion of the field force for the impending launch of Sequa. That is the biggest expense. And then all the marketing-related activities geared up towards the launch of all the 3 products, actually, Ilumya, Sequa, and Zelpros. So that's a very big ramp-up that we have had in Q2. As we get closer to market, I mean, some of these expenses are already in your base and some will get added when we are close to launch.
So this is spread across both the line items, sir, staff cost as well as the other expenses.
Yes.
Fair point, sir. And, sir, in your initial comments, you said you were evaluating generic R&D. Does this mean that there's a chance that on an absolute basis, the generic R&D spend can come down?
I don't know whether we will be able to quantify the total value, but many products that we used to look at for development in the past, we are now not looking at as an important product for us to focus on and develop. So to that extent, I think the relative attractiveness of products have changed.
Okay, sir. And, sir, just one more question if I can squeeze. In terms of, what you've paid for Odomzo and what you've spent on Tildrakizumab, ballpark, we think that you've spent about 2 times what you've paid for Odomzo for Tildrakizumab. Is the payoff period expected to be dramatically different, or payout profile, payback profile, whichever way you think about this, IRR or NPV, is it expected to be dramatically different for Tildrakizumab versus Odomzo?
So, Abhay, would you like to answer this?
Actually, I don't have the comparative numbers with me right now. But all I will say at this point is that internally we have a certain way of looking at things, and we have no dramatic difference between products. But I'm just saying this on the top of my mind. Specific cases of Odomzo and Ilumya, I don't have the figures in front of me.
Yeah, but generally my sense, I think, is that the ramp-up in the Odomzo business is not as rapid as originally we had felt that we will be able to achieve. That is something that you're working to fix. And I think if I look at the initial uptake of Ilumya, I think the initial uptake, especially factoring in all the competitive scenario, I think is quite exciting. Would you agree with that assessment? Abhay?
Yeah, sure.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, just question on the U.S. business, on the Q&Q decline, and especially ex-Taro. If you could help us explain what are the key parts which is leading to that kind of decline?
I think primarily in the first quarter had a larger component of Yonsa sales. In the second quarter, that the same quantum of sales we have not seen. That is the primary reason. Otherwise, all other parts of the business are trending as per plan.
So, but delta is quite large, is more than $40 million. So, would there be more elements of, some AG sales of Welcall or, which continues in Q2 also, or Halol, some gains on Halol or what? I mean, because Yonsa, $40 million, not able to get the numbers.
The biggest one is Yonsa. I mean, the generic business is more or less, having a similar kind of numbers month on month that I see. I'm sure, as Mr. Shanghvi also mentioned, there hasn't been a growth on Odomzo, but there has been no fall either. So, and the way I look at the numbers, I think the biggest contributor is Yonsa.
Okay, and there's no major Q&Q decline in the base portfolio is what you're saying?
Yeah, when I look at the base portfolio, I don't find a big decline.
Okay, fair enough. And secondly, on the gross margin side, there was a mention about write back of certain provisions. So I understand this is one time, but what could be the quantum? Would we normalize Q1 gross margin as the base, or how should we look at it?
I think it's difficult for us to respond to that question. Yeah, H1 I think is a better indicator.
But could you, is it possible to quantify the provision?
No, difficult, because which product will sell more? Difficult to, and we have very different product margins. If we sell a product with higher margin, then it will have some impact on the overall margin. So difficult for us to quantify, but I think H1 is a reasonable number.
Great, sir. Thanks and all the best.
Thank you. The next question is from the line of Abhishek Sharma from IIFL. Please go ahead.
Sir, I had a question around the India market decline. Last year, when we had this GST event, that also would have given you an opportunity to do destocking. In fact, it was forced upon you. So I was just wondering, why this one-time inventory reduction after such a drastic event last year? Did we aggressively restock in the market post-event, or, was there some structural way of doing things that we are now trying to change?
I think if you go back to last year, Q1 was weak for us and the industry. Q2 was quite strong. And I'll sort of say close to normal inventory levels were reached at that point. The other thing I'll mention will be, this or what my recollection of what I have seen in AVAX report is, Sun Pharma's average inventory level at the sort of stockist level is some of the lowest in the industry. So, pretty much what I'll say will be, inventory levels are sort of clearly very well monitored and we focus on prescription generation. And much of our sort of internal measurement is based on the stockist uptake and not necessarily on the primary sales. So where I'm concluding is, last year it was not that first half was in totality weak. First quarter was weak, compensated by second quarter. Compared to that coming into this year, overall as a company, and sort of looking at Dilbai also here, our efforts are to optimize working capital, improve ROC, etc. As part of that initiative, we are doing a planned destocking. It's a one-time event. We are not planning to repeat it through the year. And I'm fairly confident the underlying business is in good shape. Like I mentioned, it's in sort of low teens is the first half growth. And I'm confident that we'll maintain the momentum going into the second half.
And just like the destocking quarter, GST destocking quarter last year, there was a bounce back across the industry. Would we see a similar kind of a bounce back for you in the second half?
No. What I am saying is, the underlying demand will be sort of quite robust, and we are not planning for a restocking at this stage.
Understood, sir. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, hi, good evening. Continuing from the last question, can you please indicate rough quantum of this inventory reduction? And did it correspond to any particular therapy? Because it can't happen that across therapies you just take inventory reduction.
I don't quite remember the sort of rupees in crores. What I remember is, without the destocking, the degrowth would have been low single digits. And it was not across a particular therapy area or anything. It's more broad-based.
So can you explain this? I don't understand this. Your comment that it's a broad-based inventory reduction. How would that happen in general? So you're saying that it's a ROC improvement initiative. So in general, the inventory, either it could happen the inventory levels were significantly higher that you wanted to reduce now across the therapies. Sorry, I just don't get this.
Anubhav, as you may be aware, we have a distributor to basically sell the sell inventory into stockists in the country. So the inventory reduction is not at the stockist level, which I have mentioned is probably some of the lowest in the industry. This is sort of sale into the super distributor or super stockist or distributor of our company.
Okay.
Huh? Understood?
Yeah, that's helpful. Second question is on the balance sheet. We have seen intangibles increasing by almost 2,000 crore in first half. Can you help? Because I don't remember we guys made any acquisition this year.
Yeah. So this is regarding the capitalization of the specialty products in the current year. It's related only to that.
But which item is this bucket coming from? So where were these items? Because I see intangibles under development also going from 1,000 crore to 600 crore. But, so where were these items earlier present in the balance sheet?
So the overall milestones for the specialty products paid to date is also included in this. So the post the approvals, the launch, these have been capitalized. Accordingly, the intangibles have increased.
There were also many approval events, no? So many, what you call milestones, would have been triggered based on the approval. So depending on how the agreements have been signed, you will have milestone events also linked with those approvals. So some of these are back-ended and some of these are front-ended. So you pay. So I think that is what Murali is trying to explain to you.
But just the quantum, Dilip bhai, was $300 million is a large quantum. That's why I was thinking the milestones can't be so large. That's why my question was there.
No, but I think it's only milestones.
Okay. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Thanks for taking my question. Sir, on the R&D costs, we've had a reasonably muted H1, how's versus what a guidance of 8 to 9% R&D spend for the year. Do we see a meaningful ramp up in the second half of the year, or are we going to be much lower than our initial guidance on the R&D, sir?
So we will be actually much higher than what we are. I think I've also said it in my readout that some of the specialty business related R&D and some of the initiation of clinical studies, those costs are likely to be in the second half. Also, I think in our internal calculations, we also calculate the what you call product related milestones also as a R&D cost. It's not reflected in the financial, but when we look at, because ultimately it's all linked with the approval of the product.
And sir, on that metric, including that metric that you have, that you mentioned around the milestones, are we tracking, the 8 to 9%, or is it even with the milestones at this point of time?
No, with milestones we've actually gone significantly higher.
Okay, fair enough. And so secondly, likewise, on the other thing that you've been guiding to fairly regularly is on the on the SG&A sort of being higher because of specialty spends. Now we've had some increase in H1. So is bulk of the increase that will happen already in the base, or we have some more increase to come through?
So Abhay, maybe you can respond.
In the launch is taken place.
No, I did not get the question. Can you please repeat it?
His question is whether all the costs related to specialty business are in the base, or you will see some additional costs.
There will be. I think especially in quarter 4, there will be an increase. Plus, when you launch 2, 3, 4 products almost parallelly, there will be a lot of doctor group meetings that we will conduct in IITs that we will initiate. So there will be, I would not say all of the cost is in the base so far. There will be some which are things which we will have to do in the first few months of launch as part of our activities and strategies to make the product successful.
Okay, thanks and best of luck.
Thank you. The next question is from the line of Sehan Mukherjee from Nomura Securities. Please go ahead.
Hi, thanks for taking my question. So just continuing on that point on SG&A spend, we have seen some increase of around 100 crores QOQ, but there would have been some impact of rupee depreciation also. So, you had earlier mentioned there will be significant, so you would say the large part of the increase has already come, and what we are going to see in Q4 would be relatively lower?
This is what we are saying, that sorry, Dilip, you were saying something.
No, I was saying I didn't fully understand the question.
No, sir, what increase we have seen around $14 million on a sequential basis, because I was expecting because of the Tildra launch this quarter, it would have come, right? And that happened towards the end of it. So I was wondering whether this increase captures the kind of expense you need for Tildra, or more of it will come, and on top of that there will be expenses related to Sequa. So actually trying to understand the quantum of, increase that we could see, let's say, when we enter Q4, or in Q4 rather, when Sequa and Tildra both are, marketed.
That is what I'm trying to explain repeatedly, that I think in the next 2 quarters, the marketing-related costs will actually move up, because we will be working towards making the product successful. So while the field force cost will be now into your base almost like a constant going ahead, I think the marketing spend in the first few months of launch will be higher.
Okay. So my second question would on Yonsa. You mentioned that was a big delta quarter on quarter. So, how do you see this going forward? Was that related to some kind of inventory fill that happened, led to that increase, and, how do you see the outlook going forward for this product?
I would not call it an inventory build-up, but clearly, out of the gate, the product moved out pretty fast. In the latter half of the year, we will have, we may not be able to see that kind of an outgo of the product from the warehouses. So, to that extent, the quarter was a little slower for Yonsa as compared to the first quarter.
Okay, sir. And the final one question, if I can, on this modafinil litigation. You still have one more settlement to go, right, sir? And is it possible to quantify it? Because you had a settlement earlier, now, there's still one more left. Any color that you can give? And is there any other such settlement?
I think we have explained that this reflects our estimation of the total liability.
Okay. And sir, there is no recourse to Daiichi for this as part of your agreement?
And this is Nimish here. Can you rejoin the queue, please?
Okay, sure.
Yeah, thanks.
Thank you. The next question is from the line of Samir Baisiwala from Morgan Stanley. Please go ahead.
Thanks. Good evening, everyone. Abhay, just on Ilumya, can you give some quantitative benchmark or some color when you say that the initial uptake has been good? That would be great. And second is, given that it's a competitive market, so which are the customer or patient segmentation which is really, taking up Ilumya?
Samir, the latter question, obviously, I cannot answer of who are my customers in the segmentation. It's competitive, so I cannot really give you any color on that. On the former, let me say that, we were pretty clear of who are the customers we want to reach. And so far, when I see the first month, last week was the first month we completed of having Ilumya in market. Then I see a large number of the customers whom we had targeted in the first quarter as customers who should at least try the product, and I see that has happened. On the access side, again, the coverage that we are seeing is more or less as per our expectation. Of course, it's an ongoing discussion with different payers one by one, and since we are more on the medical side, then we have to deal with a larger number of customers because the medical formularies are run by individual payers. So we have a very large number of customers that we need to go to. But overall, coverage has not proved to be a barrier to the customer getting the product, the patient getting the product, and that is very heartening. Long way to go. It's only a month into the business. We are learning along the way and we are improvising along the way, but the team and I feel very confident about this product.
Abhay, just on that point, should we take the previous two IL launches as a benchmark as to how they did in first 3, 6, 9 months? Is that the right way to look at it? And second is, given the fact the recent other launches were auto-injectors...
In terms of trajectory, Samir, yes. But in terms of actual, you got to remember that, when you are the first, second, third, fourth in the market and then you are the sixth or seventh, you will not be able to match the units. But in terms of trajectory, that is how I would also look at what kind of access did the other IL-23 get in the first few months, what is it that we have, how many customers were they able to get to prescribe and how many do we have. So I would also benchmark, sure.
No, I think Abhay is trying to ask whether he can estimate the sales which they have announced as a quarterly uptake as a part of his future projection. So, Samir, I think you need to be clear on one issue, is that even if your product is equally good, second product in the same class generally ends up getting a relatively smaller share of the total market. And this is true
Which is what I said. The subsequent products will have a lower share.
Correct. So I don't want Samir to start putting what you call say like Cosentyx did in the first quarter, or what this is as a part of the future projection. So I think, but considering that we are a new player, considering the what you call relative lack of familiarity that we have in the biologicals, I think we are quite excited with the uptake that we are seeing and acceptance that we are seeing.
So just to complete this point, with your permission, follow on Ilumya, sir, the fact that the previous couple of launches were auto-injectors versus ours being a vial or injection, does that make a difference? And that's one. And second is the next IL, that's risankizumab, which is going to come from AbbVie. I think it would be middle of next year. So does that change anything from for you? I mean, does AbbVie get into contracting well ahead of time, and that is sort of an impediment with you as you approach for coverage now?
For a new product, I mean, there is a, you cannot legally start contracting well ahead of time. But nowadays, I mean, the laws have become a little more lenient on that. So I think a few months ahead of launch, yes, so you can start talking to payers, not contracting, but you can start talking, you can make your medical presentations and so on. So naturally, the market will get more competitive with Vision also coming in, and AbbVie, of course, has far more experience than we have, thanks to their Humira. So it has become competitive, and it was always known and factored into our thinking and planning. So, but yes, we have to maximize the time that we have before the next competitor comes in. And that's the challenge, and that's the reason why we are working on speedy execution.
Thanks. Auto-injector, sir?
Auto-injector for us, I mean, when I speak to customers, the fact that the product is, used the way it is and it's a medical benefit, I mean, if I look at it holistically, it's of actually a benefit to us.
Okay, thank you. I've got a few more. I'll get back in the queue. Thank you so much.
Thank you. The next question is from the line of Manish Jain from Sage One Investment Advisors. Please go ahead.
Yeah, I just wanted to look at the specialty side that before March 19, we will have 3 more launches. That is Cequa, Zelpros, and Ellipsia. Or will we have some more?
I'm factoring in Cequa and Zelpros.
Yeah, I'm glad you said that because that's where I had the follow-on where, typically, given that Ellipsia falls in a different segment altogether, how much time one should budget for, the sales team build-up and the other, because it's a new segment altogether for you all.
So, as of now, I really haven't made up my mind whether and how I would like to go about the marketing of Ellipsia. So, I really don't have an answer for you, but I'm grappling with the same question that, can we take on one more segment and can we take on another field force and do a new segment launch with all that we have? So, it's a strategic decision that we need to internally discuss and agree upon.
Perfect. I'll join back with you.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Thanks for the opportunity, sir. Just on the...
excuse me, this is the operator. Mr. Patra may be requested to speak closer to the phone and use the handset.
Yeah, okay.
Thank you.
Just on the spend, the launch-related expenses, what is for the specialty portfolio, which is likely to come up in the subsequent quarter. So how sticky or how sustaining that expenses would be? And that is one. And secondly, is there any sense on the break-even timeline that you would be having internally, like for the specialty portfolio? What would be the break-even time that you would be estimating?
Some of the expenses will be sticky, of course. You can't have a pulsating kind of expense on marketing.
Okay.
Of course, the initial ramp-up will always be on the higher side, and then to that extent, after some point, it will taper down and then remain almost like a constant. We haven't done detailed budgeting,
okay,
item-wise for the next few years, so difficult for me to, give you a sense on that exactly.
Okay. On the break-even side, any sense for this entire specialty portfolio project?
It's a lot of moving parts, and each product is in a different stage. I mean, something has been launched a year ago, something is being launched now, something will be coming 2 years later. But broadly, I think at least 2 to 3 years for product-wise, if I do a P&L, for at least 2 to 3 years, there will be an investment going into the businesses.
Okay, that's helpful, sir. And just extending the same question, on the overall margin front for the consolidated business, since we are of the view that, okay, the R&D spend is likely to move up in the subsequent quarter, or second half rather, and the expenses are on the specialty front also is likely to be move up. So, is it right to believe, sir, the kind of margin profile what we are having currently for the first half is relatively better than what it could be in the second half or in the near future?
No, I think we will also get some additional new business. So, okay. So generally we don't guide for the overall margin, but I'm only helping you you're only looking at the expense side of the cost.
Exactly.
But we have now ability to start selling the product and generating income. So that's something which you should factor.
Okay, so the quality of portfolio that should be improving sequentially. So that should, one should have it in mind.
That's correct.
Okay. Thank you, sir. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thanks for taking my question. Just one question. So in the last call, you had mentioned that, we are talking with customers on contracting for Yonza. Given the unfavorable litigation for Zytiga, has that slowed that process in terms of, our ability to, get adequate coverage for Yonza?
It has. And, the payers are, looking at scenarios of when the generic would come in. And we are now dealing with the what-if situations and trying to modulate our contracting strategies accordingly. So to that extent, it has slowed down.
Okay, so this would probably remain fluid for some time till, we get some clarity on the generic competition.
That's correct.
And my second question is on Absorica. Now, after the copay, the change in the copay there, we haven't really seen a recovery in prescriptions so far. Do you think, will the prescriptions stay at this level and it's unlikely to go back, to what we were doing before with Absorica? I understand it's a more profitable product for us now.
The peak that you saw with the liberal copay, it will never reach, that is for sure. But if you see the last 3 months, then there has been a steady increase in prescription. Not significant up, but there has been a steady increase in prescription. And we are also now utilizing the strategy where we are ensuring that the prior auths for the product go through seamlessly. That is working out quite well for us. So the fill rate is much better now than what we had at some points in time. So the bucket is no longer leaking so heavily with the prior auth thing that we have done.
Understood. Thank you, sir.
Thank you. The next question is from the line of Nimish Mehta from Research Delta Advisors. Please go ahead.
Yeah, thanks for giving me the opportunity. Sir, on Ilumya, you mentioned that there has been, a good amount of ramp-up or it has been exciting. So will you ascribe, the performance of Ilumya to a general shift in biologic, or it is more IL inhibitor specific, or is it more Ilumya specific, Or if you were to kind of rank order that would be very helpful.
I mean, in 1 month experience, none of these 3 questions I would have a clear answer to. Because the kind of granular data that you need to be able to make those assessments, I don't have with 1 month. And no external data I have. So even what kind of patients we have received, Which kind of patients doctors have used the product on, I don't know myself because it's too soon.
I see. But, okay, I mean, data is one thing, but some kind of intuition or some kind of, something which is matching your expectations. You can just let us know what is the
intuition will not help me answer those very broad questions of what has made the shift, whether it's a class or a product. Doctors clearly were, overall had liked the profile of the product, and therefore I think they were, eager to give it a try. But what kind of patients they have tried on and to answer that question in more broader terms, I think it's too soon.
Okay, fair point. The next one is actually on the India business. With the restocking exercise, I mean, is there any chance that, is it basically because of the GST-led structural change, which is why a lot of the depots that we might have established, to capture some tax benefit is no more important, and thus we are kind of consolidating. Is it something like that, or I'm just trying to understand?
No, I think this is fundamentally, it's our effort to improve business efficiency. I don't have any idea whether it has any tax benefit or anything like that. If it is, it's a bonus to us. This is a drive to improve the working capital efficiency, particularly for inventory levels through the supply chain.
Okay. Thank you.
Thank you. The next question is from the line of Kunal Dhamesha from SBI Cap Securities Limited. Please go ahead.
Hi, thanks for taking my question. So the question I had is on Ilumya. So you said the trajectory that you are seeing is similar to some other molecules. So I just want to understand, while your market share will be lower as compared to the big molecules.
We never said that. I said if I have to look at the performance of Ilumya internally, I would benchmark myself against competitors. I mean, with 1 month performance, how can we say that the trajectory is similar or equal or better? It's just 1 month. So I think I don't want to jump to any conclusions, and I wouldn't want you to, come to that conclusion. It's too soon. The initial response is good. That's what we said. Both from the HCP side as well as the payer side. But beyond that, I mean, I haven't said anything on this call.
Okay. And just on the similar line, how do you view the difficulty level of switching from one biologic to another biologic? Or is it purely the new patients that starts with a newer entrant?
I think I've answered this question again earlier. When I said that it's just 1 month, I don't have the data which tells me what kind of patients have doctors used or were they bio-naive patients.
No, I'm not talking about Ilumya. I'm talking about, in a general, you must have studied the market, right, that people usually don't change the brand they use because it's a chronic disease, or any insight on that?
I think the failure rate of some of the products is quite high. So after getting initial response, after a few months, maybe even a year or so, the doctors do see failures. And when they see a failure, the doctor is inclined to switch from one biologic to another.
Okay. And second question is on the API business. So this business has been going strong in the first half. So any particular reason or is it because of the China supply issues? And how do we view this business for the rest of the year and going beyond?
I have some background noise coming on my line. Is everybody hearing that, or it's just me?
Sir, that is from the line of Kunal Dhamesha. So when you're done asking your question, you can mute your line.
Yeah, sure. So the question is on API business. So the business has been doing well in the first half. So any outlook on that business, and what is driving that business in the FY19?
It's a relatively small part of our business, so I think why give so much attention? But business is doing well, and it's expected to continue to do well.
Okay, thank you.
Thank you.
The next question is from the line of Surjit Pal from Prabhudas Lilladher. Please go ahead.
Hi, good evening to everyone.
My question is on domestic formulation. See, in Q2 FY18, your growth is 11%. So, if that considered as a higher base for this quarter's number, along with, if I adjust my destocking things, is it a matter of past of 11% growth, or are we settling for a kind of a growth of around 7-8% year on year on a normalized basis?
Miss, did you get the question? Can you repeat? Huh?
We didn't understand.
Can you repeat the question?
See, if I adjust your inventory destocking with this quarter's sales, and if I consider, or as you said, is that, you know, the Q2 FY18 was a higher base, but growth was only 11%. So 11% growth, does it imply for Sun Pharma is a matter of past, so we are more of a settling of 7-8% year-on-year growth in domestic formulation on a normalized basis?
Cal, you didn't say 11%.
No, that's what I'm saying. All I'm saying is the underlying growth is sort of tracking low teens, and it's tracking to plan. And my expectation is that the momentum will continue. All the indices that you can see are fairly healthy. I'm not saying everything is working 100% to our expectation, but overall health of the business is good. And through the year, I would expect us to maintain a demand level in low teens.
Okay. Another point is that adjusted EPS, which I think you guys said is around 4.1, adjusting that extraordinary items. These extraordinary items is post-tax?
There is no tax on that.
There is no tax benefit for that. Hello?
Yeah, there's no tax benefit on that.
Okay, so straight away, okay. Thank you. I'm done.
Thank you. The next question is from the line of Ashish Thakkar from Motilal Oswal Asset Management. Please go ahead.
Yeah, thanks for the opportunity. So I have a question on working capital. So, you know, if I compare this first half with last year, have we seen a substantial change or a pressure on our working capital, especially because, you know, now halal is also ramping up and there's a specialty basket that we are promoting?
There is no pressure on working capital.
Yeah, what do you mean actually by pressure on working capital?
So in terms of, say, you know, what we were seeing last year, so if I go to see your net current assets as a percentage of sales, so is there a substantial change in that number?
I don't think, no major, nothing.
No material change. Okay, so even though halal is like gradually ramping up, you feel it would be only a normalized number that we should be working on?
Yes.
Okay, that's helpful. So broadly on FY18, if I go to see, you know, the return ratios, ROCs and ROEs, they are appearing very, you know, depressed in nature. I understand there could be various factors, but, you know, if you could help us understand, you know, how should we look at our core business ROEs and ROCs going ahead? Thanks.
I think what you need to factor is that we are building a new business, and that business requires a lot of investment, both in terms of working capital or allocation of capital, and also creating infrastructure and creating cost structures. So while all of this is happening, the existing business is funding all the future engines of growth. So when this engine of growth will start generating profitability and value addition, then we will see through overall profitability, because clearly the current EBITDA numbers don't reflect the underlying business's true profitability.
Okay. So for a while, you meant to say that, you know, the return ratios which are sub 10% currently, they would continue to remain so, or we could, the next 2 to 3 years, you are looking at something, you know, ballpark, I'm not asking for a number, but just ballpark, mid-teens kind of number we should be comfortable working with?
No, I think what I am saying is that the current cost structure is for creating a future business. So I'm not giving you any guidance, but I am explaining to you that the current profitability is not the profitability of the producing business. It's also paying for building the future business.
Okay. Got it. So just last question, if I may squeeze in. There's an increase in receivables compared to like March quarter. So anything like 1,200 crores increase in receivables.
Basically, this is a translation of the currency receivables. This reflects that increase.
But that would normalize as we approach FY19 end?
Depends upon how the currency also moves.
Okay, fair enough. Thanks, sir. All the best.
Yeah, thank you.
Thank you. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Hi, thank you. Good evening, and thank you for taking my question. Just the first one on the U.S. generic business, and you can even talk about the industry as well. Ex of Taro, how has the base business actually behaved? Have you seen QOQ increase ex of Yonsa? Have you seen increase in our base business sequentially? And just a related question on the kind of conversations you're having today with the channel, the distributors. Has it actually improved, over the year in terms of the conversations you're having? That's my first question.
So the business is doing as per expectations. I can't say that quarter on quarter there has been a big jump. We also haven't launched any major product in the second quarter. So it's in line with our expectation for the year. So yeah. When you say conversations with customers, we have always had good conversations with customers. So what were you alluding to?
So I was just talking about, is there the insistence on price discounts versus, say, a surety of supply? Have you seen those kind of narratives change? That's the key point I'm trying to say.
No, I think in the last 1 year, I don't think the narrative has really changed. There is pressure. Product specific, we keep seeing that. And I haven't changed that change. I haven't seen that change.
Got it. Thank you. And my second question is on the tilrakizumab for Europe. Has it been commercialized? And, how should we look at these two markets, Europe versus the U.S.? Anything that you can share in terms of qualitative color will be helpful. Thank you.
Yeah, I think Tilra should be commercialized hopefully by this quarter end. And it will be launched gradually country by country in Europe. So based on reimbursement and various other things which are required for Europe. So once we launch the product, I think we will get a greater clarity on how the product is doing.
Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Charulata Gaidani from Dalal & Broacha. Please go ahead.
Yeah, thanks for taking my question. Are there any specialty generic launches, or how many specialty generic launches do you plan in the second half?
Generally, we don't give these numbers, but there are some interesting products which are in the second half of the year.
Okay.
Yeah, Karuna, I may get disconnected for the next couple of minutes because I'm on a...
Sure, I will reconnect you. Thank you.
Okay, fine. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, I have just one question for Ilumya. This question was on formulary access. I just want you to understand, what does it take for us to get first or second line access to in that therapy? I understand one is a time factor, second is a price. Is there any other determinant other than that?
I don't know whether Abhay, you're still on the call.
I'm still on the call, but can I, because you spoke a little fast, can you just repeat the question and I'll answer you, please?
Yeah, so I was asking that for the formulary access for Illumia, what will it take for us to get first or second line formulary access there? I understand that right now we have a constraint of step therapy in most of the formulary access that we got. When can, let's say, a year after, 2 years after a certain point of time, what would it take for us to get that better access in the formulary coverage?
So there are two ways of looking at this, and both are different, if you ask me. There is what will it take to be a first-line therapy? That's one part of the question, and the other is what does it take to be the preferred product? Now, I don't think we are even aiming for being the preferred. As long as we have the chance to be, the first line, and then the HCP makes a choice of what the doctor considers to be his first line, we are comfortable with that. Because it's a question of how much you will need to discount to have a certain position. So the aim is to get yourself at parity with your competition. Then the HCP can then choose based on the merits of the product and the profile of the patient or what is it that they would like to use as their first line in each individual case.
That's helpful. I was just asking, is price, can a company use price as a bigger factor and therefore get advantage over competition if you are a, let's say, fourth or fifth product in the market?
More than price, it will be rebates and discounts. So not price per se.
Yeah, I'm taking rebates and discount as part of price, basically. Net effective price to a rebate.
Sure, but the question is that, how much would you like to discount and rebate the product and what do you gain at the end of it? So there's a very complex modeling that for each and every contract that we would go through, and the contractors themselves would also look at their own data, and then you come to a point which is comfortable for both the company as well as for the payer.
Okay, thank you. This is useful.
Thank you. The next question is from the line of Sayan Mukherjee from Nomura Securities. Please go ahead.
Thanks for taking my question again. Sir, can you update on the status on the few clinical trials for the Insight Vision products, and when do you expect NDA filing for those?
So I think both the clinical trials for Insight product are ongoing. I think I don't have I don't recollect the exact plan for filing the product, but it's also not expected to be, I think Abhay filed this year, correct?
That's correct.
Hello.
So sometimes next year it will be filed.
Okay, thanks, sir. And sir, on emerging market and ROW, any color you can, we don't have much clarity or transparency on, these two markets. I'm just wondering, is there any element of volatility that you see in terms of, like components of tender business, etc., that we should be aware of, or you think we should more or less expect, fairly secular growth in constant currency terms?
I think the underlying business, I'll probably sort of predict the continuity of the momentum for the rest of the year. So we didn't have any one-off business which is unlikely to either not continue or not. We are not also anticipating any one-off business to occur in the next 6 months.
Okay, thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Thank you. Just for Illumia, for Tildra, for both US and Europe, can you give us a holistic picture of the accounting treatment for both milestone and royalty? And the fact that for Europe you got the approval in September, so therefore would that not have meant a milestone inflow, or is the intangible a net number?
Can you please repeat the question, Samir?
No, I'm talking about Tildrakizumab. For example, maybe you took a $300 million milestone payment out to Merck and therefore the built out of intangible in the balance sheet. So it took it directly to the balance sheet. So for Europe, for Almirall, would it be the same treatment that you would take it through the balance sheet? And did you not get an inflow because in September you got the EC approval?
So as far as the the milestone payments, as we spoke in the past previous question, we have capitalized that as part of intangible. That is capitalized.
This is
and it is part of intangibles in the balance sheet.
Samir, you are presuming that this 300 million is all linked with Illumia. Because it's not. It's also linked with Sequa.
Okay, got it. Got it. But so the fundamental question remains that when you get the inflow from Almirall, would you also again take it through balance sheet? And did you not receive it because you got the approval from EC in September? Did that not trigger an inflow milestone?
So the other component, what you're talking about, is a deferred revenue accruing over a period of time.
Sorry?
The other component, Samir, you talked about, in terms of Almirall,
licensing
income, is a deferred revenue that shall get accrued over a period of time.
So like we are amortizing the expenses, we will also amortize the income.
Okay. I'll take it offline, not sure I've fully understood that. And just a second question, sir, on the U.S. market, when you say that the relative attractiveness of a few products is not as good, and you may take it out of your pipeline, I'm just wondering then, if you take it out of your pipeline, then who will service the U.S. market for those volumes, in the sense that India and yourself have probably the best cost structure. So, it's just a philosophical point, it's a sector-wide point. Then who does this business go to?
No, I understand. I think that is the challenge that we struggle with every day. Is that if everybody drops out, then what appears to be a very unattractive product may become a very attractive product. But at some point, you have to trade off against the probability. But your question is correct, is that, and that is what I think is the challenge for both the trade as well as the industry, is that if you current squeeze on pricing will take away the initiative and the interest of the manufacturers, both in investing for manufacturing, facility expansion, in R&D. All of that will potentially lead to future disruption in supply and future shortages, which will increase their longer-term cost.
So, sir, how does one break this cycle?
I think the only way by which the cycle gets broken is that on all the commodity products, when there is a, what you call, business becomes less attractive, the supply becomes scarce because marginal producers stop producing. And then that leads to increase in profitability, bringing new suppliers back to market. I mean, that's what will happen here also.
Oh, got it, sir. Thank you so much.
Yeah, thank you.
Thank you. Ladies and gentlemen, due to time constraint, this was the last question. I now hand the conference over to Mr. Nimish Desai for closing comments. Over to you, sir.
Thank you, everybody, for being on the call today. If you have any questions that have remained unanswered, do send them across and we'll have them answered. Thanks and have a good day.
Thank you very much, sir. Ladies and gentlemen, on behalf of Sun Pharma